Hey guys, so welcome to Trading with Dan. I'm your host Dan. So today we are going to do a video for the Trading with Dan School of Trading, and it is going to be on basic trading principles. So firstly, how do you become a successful trader? I guess I say that's firstly, but that is the goal, isn't it? Basically, that is the beginning, the end. That is what we are all here to trying to become, is to become a successful trader. But that is what we're going to break down in this presentation. So when you take a trade or a series of trades, there are four outcomes, four things that can be happening. You can be making or taking big profits from your trades. You can be or trying to take big profits. You could be taking small profits. You could be taking small losses, or you could be taking large losses. And basically any combination of those four things with a series of trades. So the problem you will have with trading is if you are taking big losses. So if you're taking big losses and small profits, then you're definitely losing money. If you're taking big losses and small losses, you're going to be losing money. And if you're taking big losses and big profits, I mean, overall, you're probably going to average out at around break even. So the main thing that you need to do when trading is to eliminate the big losses. So obviously that can be easier said than done for a beginner trader. But if you can rule out big losses, then you are very likely to be able to become a successful trader. So I've sort of found trading isn't, for me, when I first began, wasn't about thinking how can I make as much money as I can, how can I make as much money. It was, how do I not lose money in these markets? What do I have to make sure I do not to lose money? And then I would have trades that would do well, but the main thing is to not lose money, or definitely not have big losses. So the main way to do that is to obviously have big profits and small losses. You will always have losses when you're trading. I mean, only Bernie Madoff didn't have any losses, and obviously we all know how he managed that. But yes, so the main way is to run profits and cut your losses. So you want to maximize your gains and minimize your losses. So then even if you have a string of losses, you only need one good profit and you're still in profit. Or even if you have like a string of big profits and then just a few small losses, then you're going to make even more money and be an even more successful trader, or you're just going to go on a really good run. But either way, as long as you're cutting those losses, you are giving yourself the best chance of becoming a successful trader. And we are going to look in some later slides how we do make sure that we don't get those big losses. So to trade, so then another aspect of that is you want to buy low and you want to sell high. That's sort of the saying that people laugh and joke about. They say like, oh, so you a trader, you do this and that. Oh, so you buy low and sell high. And that is one way of trading. That's one way to make money. But there is also another way that people don't really. It's not sort of like, it's not like the quote that people say, but it's to buy high and sell higher, or obviously to sell low and sell lower. So that sort of goes into the trend as your friend, like breakout trading, which I personally am more of a fan of. I mean, I did trade certain markets in a certain way, so hedge strategies where you would fade move, so you would buy low and sell high, and sell high and buy low. But but I tend to favor the buying high and selling higher, so the breakouts or breakdowns. But either way, there's people that trade different strategies in different markets, either of those ways. But what it really comes down to is making the bigger profits than your losses are. So so basically, to make sure you don't have these big losses, risk management is how you basically eliminate them. So how you manage your risk in a trade, obviously your risk being losing money. So obviously managing that losing money is gonna, if you don't lose a lot because you're managing that risk, then you're gonna cut your losses. So you're gonna cut your you're gonna not make big losses. So yeah, the main way, the main single best way to make sure you don't run run up big losses is to always have a stop loss. So you always want to have a point where that's it, you're just going to be out of the market. The trade was wrong, you just admit you were wrong, and then you exit your trade. So that's one thing. You can enter your trade, put your stop loss in, and then you can be like, right, that's great. So I've got my risk is predefined. I know where it is I'm getting out. But what you can often do, because we're all human, we like to make things as hard for ourselves as we can, don't we? I know that I do on occasion. So we can move our stop losses. So move our stop loss orders or the levels we're going to get out at. So I mean, if you're going to do that, I mean, where does that end? I mean, you had it set at a certain place, and then you moved it. So you have to ask yourself, well, so what's going to stop me moving it again? And then obviously, if you're never actually going to hit your loss and you're just going to keep on losing it, then basically you don't have a loss, do you? Or your loss literally is going to be the point in time that you run out of capital, that you can't keep running that trade. So yeah, so a very important factor in trading is to not move your stop loss. So the next point is to have a trade plan. So you want to know what levels you're looking at to buy or sell an asset, and then what your potential level to get out at, or get out of part of the trade, or when you're going to start moving your stop losses maybe to break even, or how you're going to have your trailing take profit orders. And yeah, so all those things are going to be in how you plan the trade. So don't add to losing positions. So this means that, say you bought an asset and it went down, then you then buy more of it. And obviously a caveat for that is, unless it was part of your original plan, your original trade plan was to buy at a certain level with a certain percentage of the position size you want, and then buy at a lower level if the market does go against you. So this is a legitimate way to trade. It's often not recommended to take the full size of your position at just a set point. I mean, you can do it if you trade in certain ways. So say you are trading breakouts, you then want to buy out the breakout. You don't necessarily want to be buying part of it and then waiting for a retrace that could then nullify the breakout. But as a rule, it's called averaging offside. You don't really want to average offside, and if anything, you want to do the opposite. So you want to average onside. So say you buy something, it goes up, then you could potentially buy more of it. So that is the opposite to adding to a losing position, is obviously adding to a winning position. So that can be ways that traders will make big gains. So the big successful traders will be the traders that do basically what is the opposite of the losing traders. So losing traders, they'll have big losses and like maybe even lots of small wins, but the big losses are big. They will average offside, so they can have a big losing trade that will blow them up, rather than averaging onside, so they can have a big profitable trade that will make them a lot of money. And yeah, so again, a part of that is going into that sort of aspect of averaging offside, that can fall under the don't chase losses category. So what you're doing is you're like saying, well, it's gone down this amount, so if I buy some more, then I can get out of a break even when it goes up a bit. Obviously it doesn't have to go up all the same amount as it's come down from your original entry, because you have a bigger position on now because you've averaged offside. That can be classed as chasing losses. Also, just putting on a bigger trade, maybe even in the opposite direction to your original trade, or in a different market, or in a correlated asset, or an inversely correlated asset. I mean, taking more risk than you would normally do, more position sizing, more positions. That all falls under the chasing losses as well. And yeah, that brings us to our last point, is trading responsible position sizes. So you don't want to be trading position sizes. I mean, you don't want to be trading position sizes that make you feel uncomfortable, because that obviously is too big a position if you're feeling uncomfortable about the trade. And then also, I mean, you can be the sort of have the sort of personality where taking big risks doesn't make you feel uncomfortable, but you still need to trade responsible position sizes based on the amount of capital that you have to trade with, because I mean, you can't keep trading if you lose all your capital, so you got to stay in it to win it. And that brings us back to a point I said before, that making sure you don't lose money, trying your best not to lose money, is often the best way to make money in trading, as it's cutting out the losses that will then help you make money, because you will still have winners. I mean, even if all things are random, you're going to have the winning trades. So you just need to make sure when you have the losing trades that you give your winning trades every chance to make you more money than your losing trades lose you. um so yeah, so that's some basics on risk management. So you want to then try and actually develop a winning trading strategy. So however you're going to do it, based on what indicators you're going to use, how you're going to set up those, what sort of confluence of indicators, whether you're going to look at fundamentals, or technical analysis, or or just automated trading systems that will just fire based off fractal movements. So you have to basically, that is key to being a successful trader, is developing a strategy that gives you an edge. So you have to have a system or checklist, basically, that makes sure you stick to that strategy, that you know the rules, that you don't deviate from what is the strategy you're employing. Especially, obviously, if it's worked for you in the past and it's working for you, you want to keep it working for you, so you want to keep doing the same thing. So then that is to sort of enter a trade, your strategy for your entry. But then you need to have a strategy for how you actually manage the trade once you are in the trade. So how you can look at this, how I will do this often with my trading, is that I will have a position. I will take a percentage off it, often half of the position off, if it gets to a winning position of just a decent. I mean, I could say 1% or 2%, but I mean, it clearly depends on what asset and how much that asset moves. But yeah, but like a predefined set percentage. And then I will often then move the rest of the positions, stop to like a break even stop, so that trade can't lose me money. And then I will keep running the profit on the trade, or hopefully running the profit, and then either have a trading profit, or just hits another point that I think, well, there's the confluence of maybe sell indications, so then I'll just take the trade off at that point. So that is basically part of a strategy that everyone has to have for how to manage a trade once they're in the trade. So simple can often be better. I can't really stress this enough, to be honest. I have tried all sorts of different trading strategies, traded lots of different ways, and I'm not saying that more complex strategies aren't better, because they can still be good and they can still be better, but you'll often find a simple strategy can be better. I mean, even if it just comes down to the fact it's easier to keep track of, to maybe automate, to keep to just know what you do, to monitor lots of different assets for the same sort of optimal entries for trade. So yeah, there's lots of ways why a simple strategy can work better, and there is no ultra complex way to solve market movement, to basically have a license to print money. That doesn't exist. There's ways that say, like, algorithms and black boxes trade the market based on speed, because they're faster than humans, they can respond quicker to information maybe. So there's ways to, like, with speed, that you can try and get a bit of an edge, but there's not like a formula to solve the market. So if that is the case, then it stands to reason that it doesn't matter how complex a trading system is, it doesn't mean it's going to be more successful than a more simple trading system. obviously with a good management of the trade when you're in the trade. So, and then finally we come to the having to remove all emotion from your trading. And obviously you're not going to be able to remove all of your emotion from trading, because, well, you just can't do that. I mean, we are humans, we have emotions, we're not robots. So I mean, if you have a winning trade, you're going to be happy. If you have a losing trade, you're going to be a bit unhappy. But you need to not have like extreme emotions, and so you don't need to be making decisions based on your emotions, because you will find that that's definitely a recipe for disaster in trading. Right, so yeah, so back to our trading. So you don't have to win all or even most your trades. So this takes us back to the first slide where we explained how you just want to run your profits and cut your losses, make big wins, make small losses. So even a lot of very successful traders will lose on most of their trades, but then when they get a winning trade, they could make 10, 20 times the amount they would make on a typical losing trade, and then they only need to make a winning trade every, well, 10 or 20 times to be breaking even. But obviously they you would hope they'd have better batting odds than that. I mean, when I say you don't even have to win most of your trades, I mean you can still be making say 30% winners, but as long as your winners are good winners, then they're going to cover the other 70% that are losers. And then don't forget, a lot of losing trades could be break-even trades, and you just class them as a failed trade because it didn't make you a big win. So yeah, so markets can be unpredictable, and decisions that you make in markets are always based on probabilities. So when you have your setup, your trading strategy, your what you believe gives you your edge, it's not going to be foolproof. Like I said, there's no formula, there's no scenario, there's no way to solve the markets. So all the decisions that you do make based on the indicators that you use will be based on probabilities. So it's the probability of this happening. So say you observe a certain set of parameters are met, and then usually you observe the outcome that happens most often when you see those set of parameters met. So obviously you can then attach like a high probability of a certain thing happening when a certain amount of indicators align, and then that's how you will place a trade. So, but that's not to say that it's going to work every time. It's just got a higher than maybe say 50% chance of happening, or even if it's a lower than 50% chance of happening, but when it does happen, like say a big breakout, you're going to make a big win. So that it's a legitimate way of trading. It's all based on probabilities. So there's obviously there's not, you get fundamental traders, you get technical traders that trade on technicals, but you just have to remember both fundamentals and technical analysis will come into play at varying degrees in different times of like a market movement. So say for example the technical analysis of a trend is bullish, but say we're talking about Bitcoin, but then Binance is hacked, then the price of BTC will very likely go down regardless of what the technical analysis was saying. And then obviously the converse is true. So say technical analysis was bearish, and then let's say Amazon starts taking BTC as a payment, then the price will likely go up. Or more recently we had an example where the price action was definitely bearish, but President Xi of China, or Chairman Xi, or the leader of China, the Chinese Communist Party, he basically mentioned blockchain or crypto as something that they were looking into for payment. So that is possibly what sparked what was like a 40% rally in Bitcoin over 2 days when we were looking very bearish. So yeah, so then, be it fundamental analysis or your technical analysis, one thing you do need to understand, and it's a difficult concept for people often to understand, is that you can have a reason for thinking a market will go up, and then you can be right, and you can be right because it went up for those reasons that you thought. Or you can think the market will go up because of your reasons, and then the market can go up, but it could go up for different reasons. So you were right for the wrong reasons. So, and then obviously the opposite is true. You could think a market's going to go up, but it went down, but your reasons, the things that you thought were going to happen, happened, but they actually made the market go down rather than what you thought it would do and make the market go up. So you were wrong, but you had the right reasons. Or you can just be wrong for the wrong reasons. So you thought the market was going to go up, it went down, and some other thing made it go down, which wasn't something you were considering. And yeah, so this is the more subtle point on this, is that you will usually not know what the reason was right, because markets move based on all the available information to everybody, and you can't be privy to all that information that everybody has. So you won't actually know. You won't get like a report at the end of the day that said, yep, Bitcoin pumped $300 because of this, and this was the reason. This was the exact reason why. Nothing else mattered, and that was why it did that. I mean, you won't get that sort of information. So you will never actually know whether you were right for the right reasons or right for the wrong reasons, or whether your reasoning was right but something fundamental happened. So you had a technical analysis reason for something happening, and it didn't happen, but you were right on the technicals, but something fundamental took over the market, took over basically the price action of the market. So moving on. This is very important. When you are trading, you don't always have to be in a trade, and not being in a trade is a trade. So not being long or short the market, if you long or short a market, if you don't know where the market's going to go, or you maybe think the market is going to bounce at some point, but it may go down a bit first. So that is a legitimate trade. So having your powder dry, as it were, is you are in a trade. You are basically, you don't have a position on. You're not making or losing money based on the market moving, but you're also not lose or making money based on the market moving. So your capital is staying the same regardless of whether the market goes up or down. So this is very important, because taking on to our next point, trades can come and not come at any time. So you may know the expression, it's like the buses, like the one won't come for ages and three will come at the same time. I mean, it's that exact principle. So what you can have is, you can have a period of, depending on, like, say what your trading strategy is. Say you have like a trading strategy where you'll get like a lot of intraday trades, or you could then go for like a period of hours or 2 hours, or sometimes maybe even a whole day, where these short-term setups that you're looking for, you just don't get them, and then you could end up with 3 the next day, and then you can end up with none the next day again. I mean, how your setups will come is pretty much completely random. I mean, it's not random to the extent that if you're playing like momentum moves and the market is trending, they're going to come more often, which is obviously true. So it's not all of a sudden going to stop trending and then start trending. So, but overall, over a longer period of time, it will average out that it will just be random. So what you have to do because of this is not take trades just for the sake of trading. So you might think, oh, well, I've not made any money today. I've got a profit target per day of, say, $100. So I need to try and make $100. I need to try and make something because I've not made anything today. That will overall won't necessarily make your trading strategy lose your money and make you an unsuccessful trader, but it could seriously impact the gains that you can make if you do just wait for the best setups and the best entries. And then, like I said, these can come at any time. I mean, a good analogy for this is, say you go to the casino and you're betting on red and black. So say red comes out 5 times in a row. That doesn't mean it has to be more likely that black is going to come out as the next one because red kept coming out. It literally, so however many reds you get has no impact on the chances of it being red or black the next time. So if you take that to trading, so however many hours or even days if you're looking for larger term trades, that larger time frame trades. However many hours or days go by without an optimal entry, that doesn't mean that there's more likely to be one the next day. So we've got to get ready to take one the next day or get into a trade. So yeah, so like I'm saying, it's better to wait for the best trade parameters before placing a trade. Right, so say you keep losing trades. What can you do about this? What can you do if you are going, if you, well, say you're on a bad run, or you just can't seem to make money no matter what you do? So first off, you have to look at your strategy. So is the strategy that you have, was it previously a winning strategy? Did it backtest as a profitable strategy? Were you using it yourself as a profitable strategy before? So if you were, if it wasn't, then obviously it's a simple answer. You've not got a good strategy, so you need to think of a new one. But if you do know it did work before, you could just be going through a bad spell. Market could have slightly adjusted. It could be trade changing. I mean, you could have a strategy that works for trending markets and now you're not trending. Or you could have a strategy that works for ranging markets and now you're trending. So so you have to sort of look at how the market is trading, what sort of phase it's in, and then see whether you then need to adjust or change to a different strategy that works better under the current market conditions. So another thing you could be doing if you're losing money, you could be over trading. So this takes us back to our previous slide. You could be taking suboptimal trades that aren't the best setups, that don't have the best probabilities that you can get using your strategy to get profitable trades. So you could be over trading, so you might want to cut back the amount of trades you're doing, yeah, and then see if that changes your fortune. You could be chasing losses, so you could be averaging offside, so then you're getting bigger losses, so then you're losing overall. Or you could be cutting your winners too soon, so you're not getting the big winners that you need to be getting to be profitable overall. So yeah, so you could be doing that. So chasing your losses is it's not necessarily a way of losing trades, but it's a way of losing money overall quicker, losing your capital. So I mean, you could still win more trades, but your losers could be big, and then you could be losing your capital overall. So are you trading emotionally or irrationally? So if you're losing money, are you trading not based on your strategy? So you're just basically tossing a coin, which would come under the category of irrational trading, or are you trading emotionally? I mean, are you getting whipsawed by the market? I mean, are you just putting trades on when you shouldn't be? I mean, one of those could be what's happening. Is your risk management optimal? So it couldn't, maybe not just your entries into the trades, but are your stops too wide? Are you taking profits too soon? Are your stops too tight? Are you getting stopped out of trades and not giving them a chance? So you need to look at how you're managing the risk of your trades. And then if you can't pinpoint what is going on, or a way to basically get back onto a winning streak, or at least not losing money, you might just need to take a break from the market. You might just be stuck in a rut. You might be in a bad mindset. You might be so then you're trading emotionally or rationally. You just need to have a break to get away from the markets. You just need to maybe go for a run, do some physical exercise, just do something, watch a film, watch some TV, just go out for food, go meet some friends, go for coffee, anything just to take your mind away from trading, so that when you then come back, you can look at it just with a fresh mind, basically. So another thing that I find helps a lot with trading, is to leave yourself reminders. And I don't know how many of you guys, some of you guys may still be in education, but writing things down definitely helps you to remember them better. And then if you write it down, it definitely helps you see it better because it's there written down. So if you put it on a post-it and put it on your computer, you definitely gonna see it, and it's gonna remind you of it more. So you can write down some bad habits that you have, that you've learned yourself that you do more often than you should. You could write that down just so I can't say that it's going to stop you do it again, but stop you doing it, but you would hope it would at least cut down the amount of times that you do it, or make you think twice. So yeah, you write down your worst habits, write down things you do, write them on a post-it, stick them on your monitor, on your desk, just stick them where you want to stick them. So yeah, or even just stick them like next to your bed, or in the kitchen where you're going to cook, or on the fridge or something. So like when you're not necessarily watching the markets, then, and your mind, do you know what I mean, you can look at it and think, oh yeah, right, yeah, I need to make sure I don't do that. Yeah, you could write down the key parameters for your trading system, so you are clear of when you should be entering a trade. So that should help you then not enter trades when you shouldn't really be entering a trade, because you've got the clear rules. So they're like your rules. Your rules are written down so that you know that when you should be trading and when you shouldn't. So, and yet you need to remind yourself that when you are in a winning streak, you will eventually lose some trades, or lose a trade, or lose some trades. You will not keep winning constantly. So that's something you definitely need to remind yourself, because I've done this plenty of times. You go on a winning run, your position size gets bigger and bigger. You start to think that you're in tune with the market. You know what's happening. You just don't want to accept that a trade's going against you, that you're wrong, because you think you're in the zone. So you'll average offside, or just the market condition, just however it's trading, that maybe suited your strategy, will then change, and then obviously how you're trading won't work anymore, because the market's changed. So yeah, that is definitely something you have to remind yourself, is that you are going to lose trades, you are going to lose some trades. It definitely happens. So you can often find you go on a winning streak, and then you start putting trades on more often than you should be doing. But I mean, all of that aside, statistically, even if you've got a winning strategy that is going on a good run, you are still going to have a loss, because everything is down to probabilities, and you're not going to keep on winning. So yeah, so another good thing is, over time, as you trade a strategy, as you develop how you trade, you may have some observations on ways that you can tweak it, or adjust, like say how you're managing your risk, or just, you might see that a market was trading a certain way, that you can now, when you sort of see the certain signals that it's trading in a similar way, you can maybe adjust some of the parameters that you use if you can see that happening. But yeah, you can often, people will often specialize on certain markets. Like, I know people that will only trade the oil markets, and that's just all they trade, and so they just keep an eye on that market, and they sort of like, they kind of know how it moves. The market will have its personality, how it will be different from other markets, and they're in tune with that, and then that's all they need to trade. So yeah, so if you can learn these nuances of a particular market that you maybe begin to specialize in, you can obviously help increase that edge, which then will help you become a successful trader. So this is very important. So don't FOMO into a trade. So for a start, if you're FOMOing into a trade, then you clearly aren't executing your process. You aren't trading to your strategy, because the FOMO can't be part of your strategy. So yeah, so when a market is having a blow off top, or it is having a capitulation drop, those are the times to get out of a trade. So say you're long something, you want to be getting out. So when it's having its blow off top, you don't want to be getting out when it's, say, going on a smooth run upwards, like a smooth low volatility grind up. You want to be getting out when the stops, basically the shorts, capitulate and have to buy and spike the market up, and then more people jump in buying, the FOMO people buy in, and that's when you want to be getting out of some of your position. And then obviously the opposite of that's true as well. So say the market is basically dropping very, very fast, and it looks like it's a capitulation. That's the time when, if you were short, you want to get out of trades. So yeah, the big traders, the smart money and the algos, they will be getting out of their positions and selling into. So long positions they've got on, they'll be getting out and selling into the blow off tops. So these guys can be squeezing the market up, knowing that they're increasing the pain on the people that are short, knowing that they're enticing more people to short that market, and then they keep squeezing it up, and then they know they've got all that pent up like buying power, just waiting to have to trigger their stops and spike the market up, and that's when they will then get out of their trades. So, and then obviously the opposite is true. These big traders or smart money and algos, they'll be buying into the capitulations. So they'll be, as the market is sort of like drifting down, they'll be selling into it, squeezing the people that are long, maybe encouraging more people to buy and go long, and then they will go hunting for those stops. And then when they hit those stops and those forced sellers, the forced sellers come into the market, that's who they want to be buying into. They want to be buying from the people that don't want to be selling. So I mean, you can think about it, that's a lot like life. If you want to be buying, you're buying when someone has to sell, basically. So you're the one in control of what you're doing. You don't want to be the guy having to say, oh, you like next door's house or something, but he's not necessarily planning on moving or anything. You would have to offer him more money to get that house. That's not what you want. You want it to be the opposite way around. You want him to, like, he needs to go and he needs to sell the house soon, and you can then make him a better offer, a lower offer, and get the house for a better price. So that's what you want to be doing. You want to be buying into when people are forced sellers, and so, which is a capitulation dump, and then you want to be selling into when people are forced buyers, when we're having a blow off top. So yeah, so when you have all this FOMO, obviously that's the volatility will be increasing in the market at that time. So that will basically mean it's a higher risk when you take a trade, because you're getting bigger movement. So you have to manage that higher risk by putting on smaller trade sizes than you would normally do. So that obviously goes without saying, doesn't it? So yeah, you don't want to be, the market's going crazy, but you're putting on your same position size when it's moving twice as much. So I mean, what if it moves twice as much against you? Then you're going to lose a lot of days or weeks worth of profit. So yeah, so when you get maybe a FOMO move, a spike up or spike down, often it's kind of like waiting for the second innings. A lot of people will be waiting for the retrace, and then buy on the retrace. You'll often see a market will spike up, come down a little bit, and then keep going upwards again. So what you'll have the people that were just holding on to their, say the market was spiking up, they were holding on to their short trade for dear life, and then as soon as it looked like they were going to get a better chance to get out, so their P&L was not looking as negative as it was, they're like that, and they're going to take the opportunity to get out. That's going to drive the market up, and then you're going to get the buyers that aren't FOMO buyers that then want to get long because we've had a breakout, and they're then going to jump in at that retrace. So it is a good try. I mean, if you watch markets enough, you see enough of these sort of blow off tops or capitulation dumps. You wait for the retrace, and that's when you then plow in long or short based on whether the market was having a blow off top or was capitulating. So so to another aspect, I mean, trading is hard. No one can tell you trading is easy, but the principles of trading, the basics, are easy. So the reason why the basics are easy, but the actually execution of it and doing it is hard, is because of how humans are, human psychology. So an analogy that I like to use is, say you go to the supermarket and you want to need to buy some milk, but the milk price is double what it normally is. So you're just going to hold off buying that milk. You're not going to buy it. So you're not going to buy it because it's gone up by that amount. You're going to maybe wait till it either comes back down or goes on sale. So this is like with trading. So when something's going up and is in an upwards trend, your sort of human psychology is always like, when do I sell it? When do I sell? When do I sell? So I mean, if you look at the market at the moment, on this day, Tesla is having like a very big rally. And lots of people were shorting it before. They're getting squeezed out, and then lots of people are then looking, well, when do I short? When do I short this? I mean, that's a human psychology. I mean, they've been watching it maybe for the last month or so, thinking, when do I short? When do I short? But in reality, the market's been going up. So as say back to our milk in the supermarket analogy, milk doubled in price. So you would then buy more milk, and then obviously it's going to quadruple in price and keep going and go up more, and then that's like the trend is your friend. So but that does go against what humans want to do. Lots of people are selling into this Tesla move, but it's like it's going. I mean, that's sort of the opposite. Anyone that bought into this Tesla move did the opposite, which is buying and buying and buying rather than selling and selling because like, oh, this has gone up too much, it's got to go down. That's like their human psychology telling them that they're gonna, anyone that's bought is gonna made loads of money, done really well. But that's sort of the opposite. So, and again, when like, well, this is the same as the Tesla analogy. So when humans want to sell something, not buy it when it's going up. So say so the first example was humans want to sell something and not buy it when it's going up. So then they don't want to buy them up, or they want to buy it when it goes down. So say something was crashing, say when Bitcoin crashed from 20k down to 3k, the whole time someone's like, oh, it's gone down, it's cheap, when do I buy? And they're looking for buy entries, when in reality it should just be sell until it starts going up again. So this takes us to the famous saying in trading, the famous saying, I say this so much, like the trend is your friend. So yeah, so if something's going up, just keep going up. It's going to keep going up until it doesn't. So the trend is your friend until the end, until it stops going up. But if you buy something when it's going up and up and up, or sell something when it's going down and down, fair enough, at the end of the trend you're going to lose a bit of money, but overall you're gonna make more money than you lose just by just going with the trend. So yeah, so not getting attached to a trade. I mean, as a human, you want to be right, you don't want to be wrong. So you can in a way get attached to a trade if you think, oh, the market should have gone up, it should be going up, and then it goes down, and then you're just looking for buy entries, so you think, oh, I'm right, it's got to be going up, it's going to go back up. I mean, you're getting attached to that bullish trade on that asset, and that's, I mean, that's just part of you not wanting to be wrong. You wanting to basically have the do you know what I mean, just to know that you were right. So you keep trying to get into the buy trade so you can then make money, so then you can know you were right in the end, and that you were smarter than the market. But this brings us to our next point, quite nicely to our next point. The market is always right. It doesn't matter what you think or what you say the market should be. Where the market is the right place for that market at that time. So at the moment, people are saying Tesla's rubbish, Elon's a fraud, the company has massive accounting fraud, its share price shouldn't be where it is. But yeah, based on those fundamentals, if they are true, the market shouldn't be where it is. But based on the supply and demand for those shares in that company, the market is exactly where it should be. That is the balance of the buyers and the sellers. We've got an equilibrium of the amount of people that want to sell the shares and the amount of people that want to buy the shares. Not an equilibrium of the amount, but of the price of the share that they're willing to transact. So the people that currently have the share and are holding the share, and this share price, as the share price is running up, they want that amount of money to sell their share, to get out the trade, or to go short, or to basically sell the share. So the market is always right. So this takes us back to a point we said earlier about fundamentals and technicals. I mean, fundamentals can say one thing, but the technical market can be moving another way, on technicals. So, and then finally, that brings us to expect the unexpected. So, I mean, using Tesla again as an example, I don't think many people expected Tesla to be at nearly 800 when it was whatever price it was a month ago. But what this is, I can't stress this enough. I cannot stress this enough, that the markets will always do things that you don't expect. Like, always. More often they'll do things that you do expect. They'll do things that you don't expect. Even if it's like you're in a trade and you're right and the trade goes up, the trade could go up way more than you thought it was going to go up, which wasn't what you expected. Or you could have thought the market was going to go up and then it went down loads. So I mean, that's not what you expected. But as a rule of thumb, always, as much as something may sound like it's ridiculous, you don't think it can happen. I mean, this is your human psychology telling you this. Your human brain, however it's wired up. I mean, not an individual, but how humans as a species, how our brains are wired. We have sort of recency bias. Like, if a price is around a certain level, we just can't. Our mind just tells us that it can't be that much higher. It's just how our brains work. I mean, so when it then does go higher, which prices can clearly often do go a lot higher or a lot lower, you just don't expect it. But this is one thing I've learned over trading over the one thing I know to be a constant in trading, a fact, is that things that I won't expect will happen. Prices will go further up than I expect. They'll go further down than I expect. They will go down when I was certain they will go up, and they will go up when I was certain they'll go down. And it's way more often than not, the unexpected happens rather than the expected. So, right, finally, that brings us to, obviously, I've traded all sorts of financial markets over the years, and those so a lot of what we spoke about obviously applies to all markets. It's general trading theory. We'll just have a quick slide on Bitcoin specific trading tips, because I know that a lot of you guys and a lot of people trade Bitcoin, trade crypto. So the first thing is to always chart on Bitfinex. So you mean Bitmex charts, they're okay, but often you can get big wicks, you can get bigger movements that you don't necessarily get on the Bitfinex chart, because the Bitfinex chart is a chart that is based on an actual Bitcoin trading. So it's not like 100x or 10x or whatever it's leverage. It's just a non-leveraged account where it's people buying and selling that Bitcoin. So yeah, so always chart on the Bitfinex account, because that is the real price of Bitcoin. The price that it is on Bitmex is just the price that it is on Bitmex, based on the buys and the sells that are going through, and the order book that's going through Bitmex, and the volume and just the trades that are going through Bitmex. So markets can be very liquid and volatile. So the Bitcoin market itself, which is one of the biggest and most liquid in crypto, is very illiquid and volatile compared to regular markets. So I mean, you can only just then start to think about what a lot of these altcoins are, and these smaller altcoins especially. They are massively liquid and massively volatile. So that is something you definitely have to be aware of, which is partly why I err on the side of breakout trading and buying highs to sell higher and selling lows to sell lower, because again, back to the unexpected, markets will have big moves, keep going and keep going. I mean, look at what Bitcoin Cash did recently, and Dash as well has gone on a bit of a crazy move. I mean, people don't really expect those moves. A lot of that's down to the illiquidity that obviously breeds the volatility. Yeah, so and then you get the unexpected happens. So so basically it is the Wild West. Trading crypto is the Wild West. There's no real regulation on these exchanges. People can spoof, they can do whatever orders they want. I mean, a trick that I know that people will do, they will take like a big leveraged, say, short or long position, and then on Bitmex, which is obviously not a price discovery market, and then they will then dump, like, say, buy a load of actual physical Bitcoin on a spot market to force the actual price of Bitcoin up, and then they'll profit on their highly leveraged Bitcoin trade. Even if they just cause a spike up, they get out of their trade on Bitmex, and then they end up losing some money on their actual spot trade that they used to force the market in the direction they wanted to do by like a market buy or a market sell of a large amount of Bitcoin. They make a lot more Bitcoin on the on the margin exchange at say 100x, because they can put on a 100x trade because they know they're about to hit the spot market with physical Bitcoin. So yeah, so it's the Wild West out there, yeah. So that brings us to the don't look at the order book. 95% of it is spoof. The trades don't really want to be filled. They're not really there. They're giving the illusion of levels and supports and resistances. And then the big trades that do want to be there, they'll often have them hidden, because if you've got a big position you want to fill, you don't want people to look at it and then think, all right, we're gonna lean on that order then to buy, so you don't get filled. So a lot of orders will be hidden orders, and then a lot of orders that you see will be spoof orders. So I mean, on the balance of things, it's relatively useless to look at the order book. So, and then obviously combining all of those, stop loss hunts are common occurrences. So you will get like a spike down or a spike up just to wipe out stocks to find liquidity, so some bigger traders can get in their trades, which is like, say, the blow off tops and the capitulation dumps happening like in a split second on Bitcoin, so that they can get filled and then drive the market upwards and upwards, and then get people then to FOMO in, and then they'll obviously sell into those forced buyers, or as in the forced buyers, the people that we stopped out of the short. So yeah, so yeah, there's some Bitcoin specific trading tips. So yeah, so that brings us to the end of our presentation on the basics of trading. Thank you for watching. So if you're watching this on YouTube, obviously you know what my YouTube channel is, Trading with Dan. My Twitter is @TradingWithDan, and my Instagram is Trading with Daniel. Trading with Dan wasn't available, so I just went for Trading with Daniel. And then also the Discord and Telegram links are in the description of this video, so obviously feel free to join up for those. So yeah, so remember, none of this is financial advice. I'm not a financial advisor. It's just for educational purposes. Do your own research. Remember, trading all markets, all financial markets, and especially crypto, Bitcoin, are high risk. Only trade or invest money that you can afford to lose, and always consult your financial advisor before making any big investments with money that you can't afford to lose. So yeah, thanks for listening, guys, and I look forward to speaking to you again.